When U.S. natural gas went insane. The 60% shock that no one saw coming. For most of the winter, the energy market was bored. Traders were relaxed, models were calm, and natural gas, one of the most volatile commodities on Earth, was being treated like a dead asset. Prices were low, positions were crowded on one side, and the consensus was almost arrogant. This winter will be warm, nothing dramatic will happen. Then, in just 2 days, everything broke. Natural gas didn't rise, it exploded, up more than 60% in 48 hours. A vertical move so violent it forced the entire market to stop pretending it was in control. This wasn't a rally, this was a repricing shock, the kind that only happens when reality crashes through bad assumptions. And the trigger? A brutal, fast-moving force from the north, known simply as the Arctic blast. The moment the script flipped. Markets don't usually change their minds overnight, but weather models can. For weeks, forecasts had been signaling a mild winter across the United States. Less heating demand, plenty of supply, no reason for panic. So traders did what traders always do when they think the future is obvious. They shorted natural gas, aggressively. Funds piled in, retail followed, everyone bet the same way. And then the models flipped. Not gradually, not politely, they flipped 180 degrees. Suddenly, meteorologists were talking about sustained sub-zero temperatures across the Midwest and Northeast, a deep freeze stretching for days, then weeks. Heating demand projections surged, storage draw estimates were revised upward fast, and in that moment, the market realized something terrifying. It had been catastrophically wrong. From theory to panic. There's a big difference between academic demand projections and real-world survival. When temperatures plunge, people don't optimize consumption. They turn on the heat. Homes, factories, power plants. Demand doesn't rise linearly, it spikes. Traders who had been comfortably short suddenly had to confront a new reality. If this cold held, storage would drain fast, and if storage dropped too far, price would not negotiate. That's when fear enters the room. Supply, strong, until it isn't. On paper, U.S. natural gas production was high, record level even, but extreme cold doesn't care about spreadsheets. In Texas and other producing regions, temperatures dropped low enough to cause freeze-offs when wells, valves, and pipelines physically freeze. Production doesn't collapse, it doesn't need to. Even a small disruption, when demand is exploding, is enough to unbalance the system. That's the cruel math of energy markets. When demand surges suddenly and supply tightens even slightly, price doesn't move gently, it snaps. The short squeeze no one could escape. This is where the real damage began, because this wasn't just about new buyers entering the market, this was about forced buyers. For weeks, the market had been heavily short, everyone was positioned for warmth, but when forecasts flipped, those short positions became ticking bombs. As prices started rising, stop losses triggered, margin calls hit, risk managers panicked. Short sellers had to buy back contracts, not because they wanted to, but because they had no choice. This is what turns a normal rally into a vertical spike. Every buy pushes price higher. Higher prices force more shorts to cover. More covering pushes prices even higher. A classic short squeeze. Textbook, violent, unforgiving. Within 2 days, natural gas had posted its largest 2-day gain in history. Not because the world was running out of gas, but because the market had mispriced risk. And then there was LNG no one could turn off. And then there was LNG. While domestic demand was surging, America's liquefied natural gas exports were still running near full capacity. Europe needed supply. Asia needed supply. Those molecules were already spoken for, which meant the U.S. couldn't simply redirect gas inward without consequences. The export valve was open, and it stayed open. That made domestic storage even more vulnerable. In other words, just when the US needed flexibility, it had very little. Why this move felt so violent? Natural gas has always been brutal, but this move felt different because it wasn't driven by speculation alone, it was driven by misjudged reality. The market didn't slowly reevaluate conditions, it woke up and realized it had been asleep at the wheel. And when markets wake up like that, they don't apologize, they overreact. What happens next? Two paths. From here, everything depends on the weather. And that's the cruel irony of natural gas. It is one of the most complex, capital-intensive commodities in the world, yet in the short term, it lives and dies by temperature forecasts. Scenario 1. If the cold persists, prices can stay elevated and storage levels will fall faster than expected. In that environment, volatility remains extreme and upside risk stays very real. Scenario 2. If forecasts flip again, if warmth returns, natural gas can collapse just as fast as it rose. History is very clear about this. Natural gas gives back weather premiums quickly and without mercy. The real lesson. This wasn't just a weather story, it was a positioning story, a psychology story, a reminder of how fragile consensus really is. Markets don't break because something happens, they break because everyone believed the same thing, and that belief turned out to be wrong. Natural gas didn't go insane, the market did.